Okay, brilliant. We're underway. Well, thanks very much, everyone, for joining us today for Home Loan Essentials and Secrets Part 1. We have myself, Drew Flaum, and Trish Matusiak. Did I get that right, Trish?
You did.
Yeah,
well
fantastic.
Done.
That's good. I was just saying to Trish earlier, I'm not very good with names, so I'm glad to get that one.
I'm married into that name, so take that one.
Brilliant. Trish, I'll let you introduce yourself.
Sure. So my name's Trish, as you mentioned. I'm a mortgage broker, and I've got my own business, and yeah, I'm really passionate about helping individuals meet their financial goals and ultimately paying their mortgage off. So a little bit of background about me. I'm a client at Munros, and yeah, really happy with the services that they've provided. And in our last meeting, we were sort of having a bit of a chat, and Drew mentioned, hey, Trish, I think some of our members could benefit from some of the things you've told me. So that's what brings me here today.
Oh, thanks very much, Trish. That's fantastic. Let me just spotlight my video. I hope that works fine. Brilliant. Oh, hang on. I see an issue there. The slides aren't coming through. There we go. There we go. Sorry about that. Yeah, so I'm Drew. Many of you know me. I'm director here at Munros. I love helping businesses make more profit, pay less tax, and live happier lives. As I always say, that last part's extremely important. Live happier life. And as I put on there, I finally got my haircut fixed up. I did the whole clipper shave with COVID-19, so that's all fixed up, and I hope I'm looking pretty good for this webinar here, if I can say. About Munros, many of you are Munros clients at the moment, but we do have some people who aren't Munros clients on here today. So just a quick mention. We're very much all about tax and business services. So we do a lot of tax returns and financial statements and helping business activity statements. We also do due diligence reports. So if you're buying a business, you want to make sure it's all hunky-dory before you buy it. No cobwebs for sure. Succession planning, so particularly in the farming sector, but all across businesses in WA, and estate planning, making sure that your wills are prepared tax effectively. It's very important that when you're passing down your wealth to your loved ones, that's going to have the least amount of tax as possible. And also we're very well known actually in the cryptocurrency space all across Australia for doing some fantastic tax planning there. On the subject of tax planning, it's currently June, and we are doing a number of smart tax plans for our clients. So if you want to have a lot of peace of mind about your forthcoming tax bills over the next 12 months and reducing those tax bills as much as possible, get in touch with us now. And then finally about Munros, I'm very proud. I always mention our Google reviews, and particularly I wanted to mention one we received very recently, earlier this week, in fact, from Jack. Jack there said, Drew and Cherie are the best accountants that I've had so far. So I just thought that was fantastic. So thanks very much, Jack, and thanks to all our clients who've left us 5-star reviews. So today's about achieving your property goals. In particular, I thought it was worthwhile putting this webinar series on with Trish because COVID-19 has obviously had a massive impact on the market, and there are definitely a lot of opportunities to save tax and take advantage of the market. I actually certainly am. Trish, you don't know this, but I'm actually in the process of buying a investment property at the moment, yes. And taking advantage of the incredibly good rates there. So I've been learning a lot about all the options available, and even more since our conversations. So what we're going to do, there's so much to talk about, so many essential bits and little secrets to talk about. We've split the webinar series up into 2. Yeah. As mentioned there, we're going to hit up today, mainly going to try and hit up those first 2 points, why you should be reviewing your home loan if you got one at the moment, why I suppose when you do get one, if you don't have one now, you should probably do that on a regular basis, and then how you can pay your loan off faster, 2 key points, and then we'll get into some other stuff in the second webinar. Probably more of the essentials today than the secrets. Secrets, leave the more juicy stuff maybe for the second webinar. And can I say, if you've got any questions throughout, please use that Q&A button on your Zoom up there to submit questions, and we'll try and answer them towards the end of the webinar. It's going to be roughly given about an hour for the whole webinar, so we'll probably have a chat for, I don't know, 45, 50 minutes and then answer some questions. But questions come up throughout, and they're applicable, we'll try and answer them there and then. And of course, you always got to put a disclaimer in these things. It's just general information. It's not tailored to your specific circumstances, so it isn't financial advice. Should you need tailored advice, you'd need to speak with an appropriately licensed professional. Okay, so, yes, and of course, Munros are putting on these webinar series, not just about tax, whole bunch of information around saving you money, making more profit, paying less tax and living happier lives. This is what we do at Munros. So particularly like to point out, if you're not currently a client of Munros and your accountant isn't having these conversations, then make the switch to Munros, is our message. Okay, so Trish.
Thanks, Drew.
I think I'm spotlighted on the video at the moment, but let's spotlight you because you're the master of all this today, if I can say that. Yeah, what should we be doing around reviewing our loans?
Perfect. So I might, good segue, mentioning about COVID-19 and the impacts that's had on the economy. We know that the banks profited towards the end of March, well, not profited, but were given a stimulus package towards the end of March from the government. $71 billion was given to the banks to keep businesses, small businesses and businesses afloat during the pandemic. Using those funds, the banks did a number of things. They set aside some funds for small businesses so that they could borrow $250,000 interest-free for a period of time. They also did short-term overdrafts and looked at deferring payments for those who were in need. So, the arts industry, the hospitality industry, photography industry, all those kinds of things where we saw major changes, all places were shut down. The banks were encouraging, the government was encouraging those employees of businesses to speak to their banks to defer their payments. So the second part to that was that the banks also looked at their existing interest rates and reduced their interest rates down even further. So we had a Reserve Bank drop early April from 0.5% to 0.25%. So the cash rate as it stands sits at 0.25%, lowest in history. And the banks are offering interest rates variable around about the 2.5% at the moment. If you're looking at a variable rate, principal and interest owner-occupier home loan. If you are looking at a fixed rate, however, there's some amazing discounts that have been applied off the standard variable rate. So fixed rates are hovering around about the 2.3%, with a few mentions to some of the second tier lenders, Bankwest, ING, who are actually even lower than that. So it is a really, really good time to review your existing home loan at the moment. And if you are sitting on a variable rate over 3% interest rate, then jump on the phone to your mortgage broker, your bank, or myself. We can have a look at that for you. So that's a big part about where we're at the moment and why interest rates have changed dramatically in the last few months. And yet, definitely worth picking up the phone if you haven't already done so and speaking to your bank about where your interest rate is at.
Just on that, Trish, about contacting the bank there.
Yes.
We were having a good conversation around this, around how the banks actually sort of deal with that approach from whether or not it's coming from their customer.
That's right.
Or their customer's broker.
That's correct.
Yeah. So maybe you want to...
I'll elaborate on that. Yes. I was telling Drew, here's your number one little secret, I guess, your golden nugget for the day. If you as a client are calling your bank, they are going to refer you to a customer retention team. That customer retention team, it's in their best interest to keep you happy and offer you a rate that's going to keep you with them for, the next 3, 4, 5 years. So they're not going to potentially give you the best rate up front. And I think this is where I have arguments with the banks going back and forth, because what it causes is an issue. You're not getting that rate from your bank to then go and compare to another bank or another another lender. Whereas when a mortgage broker calls up, they know that you're at that time where you've engaged somebody else to look at it, and the bank is going to give a mortgage broker the best rate to retain that client. So potentially, if you were to call your bank and get one rate, and let's just say it was 3.1, say you're on 3.5 at the moment, and you call the bank and they say, look, Mr. Joe Bloggs, you've been with us for 15 years. We're happy to reduce your interest rate to 3.1%. How do you feel about that? You say, okay, well, that's a 0.4% drop. Wonderful. Happy to go with that. But if I was to make that phone call, I might be able to get you 0.2, because I'm going to have that challenging conversation with that consultant to say, well, actually, we've got 3 other banks here. Those banks are offering below 3%. You know, you're offering 3.1. It's actually in my client's best interest to move their finances to another bank, to retain that client, which is where they're potentially, what they're employed to do so, or to do. They are potentially going to reduce that rate even further, or send it off for an approval with a manager for a discretionary rate to come down below that 3% or below the 3.1%. So yes, thank you for reminding me on that one. And it doesn't cost you anything to pick up the phone and have a chat with a mortgage broker as well. My phone rings and I'll answer it and I'll have that generalized conversation. We're doing this day in, day out. We know where the interest rates are sitting. So, and we'll get to interest rates in the next screenshot, the next screen, and do some calculations around how much you can save on the differences between rates. So thank you again for that one, Drew.
You're welcome.
The interest rates are ever changing, and about 6 years ago, the banks liked to confuse the interest rates somewhat. And whether you had an investment property at the time or you had 2 mortgages, you may have noticed that the banks were giving 4 different interest rates. So they were giving a rate if you were owning your own property and on principal and interest, or you were owning your own property and on interest only, or you had an investment property that was principal and interest, or an investment property that was interest only. Now, this caused a massive confusion around what the best rate was, because with any one bank, let's take Commonwealth, for example, one of the biggest banks in Australia, they were offering on their scorecard in excess of 15 interest rates, depending on whether you were borrowing with a 20% deposit or a 95% deposit, whether you were looking at borrowing principal and interest, so that's reducing debt down, or interest only. So clients were picking up the phone and speaking to mortgage brokers, trying to ask us to help them navigate through to the banks to find the best rate for them. And I can say that in the last 6 years, mortgage brokers' introduction of clients to the bank is now over 60%. So that means that 60% of clients would prefer to use a mortgage broker than going direct to a bank. So that might be a good indication of how confusing it is out there to, you know, Commonwealth Bank is offering 15 products. That's just one bank. You times that by 30 banks and all of a sudden you don't know where to start.
So 40% of people go directly to the bank.
Yes.
Wow, I'm actually amazed at that figure being so high. I would have thought, it should be 80% are going through a broker. I would have thought at least, you know, sort of similar issue. I would have thought the statistics would have been around doing your tax return yourself. Like if it's a very simple matter, do it yourself, but it gets more complex.
Do you know what the stats are on how many people would go to do their tax return themselves? Would it be a similar statistic, or?
It's definitely a high proportion are actually going through a tax agent. Compared to these statistics you're mentioning. That's why I'm a bit amazed by those statistics. But definitely you get a lot of value by using a mortgage broker, for sure. Like you're almost certain to save a lot of money.
And I think the big part of that is it's not a one-off transaction. It's a journey into setting some financial goals and being able to meet them. When you have a transaction or you're getting a home loan and you go direct to a bank, that's a one-time set and forget loan. And the reason I know that is because I worked for a bank previously to having my own business. And I've been in the finance industry for 17 years. And one of the things that really stuck with me when I was working for a bank directly was that it was such a transactional event. And you would see the client, you would do their home loan, you would set up their mortgage repayments, and then that's it. You wouldn't speak to them again unless they came back to you in a couple of years' time for an increase or something like that. And I guess the big thing for me is I want to make sure that you are achieving your financial goals. You're paying off that loan as quick as possible. Probably not so much what the banks want to do. They want you to have that loan for as long as possible so that you pay the maximum amount of interest. Whereas as a mortgage broker and at Leading Edge Finance, our goal is to help you achieve your financial dreams as early as you can using the features and facilities that banks have to offer within their home loans and a little bit of budget planning to really maximise the savings for you and effectively paying your loan off faster.
Can I play a little bit of the devil's advocate here?
Go for it.
Trish? So as a mortgage broker, you get paid for when people come through you and take up the loan. Mm-hmm. And then there's further trailing commission.
That is correct.
For people actually continuing to have that loan.
That's right.
Some people could, I suppose, look at that and go, well, aren't you incentivized then for people to have as much debt as possible? Mm-hmm. I think some people would like to know sort of how you answer those questions.
Yeah, definitely. Yeah. So thank you. That's a good segue. Another good segue. But basically, as a mortgage broker, some mortgage brokers will charge a fee or a holding fee, I guess you would call it, a commitment fee to sit down and review your finances. But I'm happy to say for the clients at Munros, and we're waiving those. So there is no fee to sit down with a mortgage broker or with myself and review your finances. Moving forward, what happens is we discuss all the options, and if it is worth your while and you're going to gain a savings benefit from moving your home loan, and we are going to place that with another bank, then I get paid a upfront commission for introducing that business to the bank. So they don't have to pay their staff. There's an ongoing salary, premises for having staff sitting in their branches. I'm essentially a contractor to that bank. But the beauty of it is it's in my best interest to make sure that whatever product we choose is going to be the right product for you, because the way that I get my business is through word of mouth. Now, going back to the remuneration of the trailing income, we get a trailing income for the lifetime that your loan is with that bank. So some would say that as a broker, it may be in my best interest to keep your loan or for you to pay your loan off as slow as possible. But what makes me stand out from other mortgage brokers is that I really want to make sure that you're meeting your financial goals. So if it means that you want to pay your loan off in 5-10 years, there might be opportunities for you to buy an investment property or invest in some shares and draw down on your loan that way. If I'm giving you a great service, you're going to hopefully refer me to your family and friends, next door neighbours, work colleagues. So it's really about finding a niche in the market and working with you on an ongoing basis to make sure that you're happy and you're reaching your financial goals. The trailing income, it's actually quite funny how that came about, because going back to 2007, the banks were having, and this is where brokers versus going direct to a bank might have only been a 25 to 30%. So 25 to 30% of clients would go to a broker versus going direct to a bank. But what the banks were finding was that every couple of years, clients were moving away from them as a lending institution. So what was happening is, because the brokers were getting paid an upfront commission, you might say it was in their best interest to review their loan every 2 years and refinance them away from that bank. So what they did is they took our upfront commission that we were paid and split that into two payments. One was an upfront payment, which was about 70% of the amount, and the 30% was defaulted as a trailing commission to keep those clients with that bank. So it was a way of keeping brokers and brokers honest to ensure they were looking after the best interests of their clients. So that happened around 2007, 2008. And that's how we're remunerated at the moment. So I think if you're looking at it as a whole, it's not actually costing you anything to use a broker. And you're not certainly, banks don't offer better rates if you go direct to them versus if you go to a broker. So the rates that are on offer and advertised with a bank are the same rates that I can offer as a broker. So yeah, that's how we're remunerated.
Yeah, fantastic. And with that, is any of that going to change? Because there was that banking royal commission and stuff. Is it all pretty much looking like it's going to be the same? Or
yes. So there was a banking royal commission last year into the way the bank's day-to-day businesses run. And it wasn't an inquiry into mortgage brokers, I'll just say that. It was an inquiry into the banks. But one of the points that was picked up was with mortgage brokers and this trailing commission and how it works as an ongoing, for the life of that loan. So there's been some strategies put in place already, and it's due to be reviewed in 2021. And we know that the financial advisors have had something similar come out where there's some extra accreditations that they may have had to do, or hoops that they may have had to jump through. But as far as mortgage brokers know, we haven't had any significant changes in that. What we do need to make sure is that when we provide finance to a client, we're doing it in their best interest. Now, there's a little bit of grey fuzziness around what the best interest is. So there is a duty coming out in December called the best interest duty. And there'll be more information about that later on. But basically, it's fundamentally, it's looking at, is that the best interest rate on offer? And is it in the best interest of that client to take that product? So as a mortgage broker, we have access to over 30 lenders on our panel. And it's a matter of working out, based on what your needs are as a consumer, what's going to be the best loan for you. And I guess making sure that we're not selling a product that's got a really high interest rate because it would potentially pay a big commission, or we might be taken to Sydney on an annual conference or something like that. So which has to be declared by the broker if that is the case. So we're very upfront with all our compliance documents. We will tell you straight up how much we are going to be earning from the bank or what that commission is, and you get a copy of that. So yeah, we're very upfront about our commissions and what we're being paid from the bank.
Yeah, fantastic. Now, so when it comes to a broker, it's not just about, well, I suppose when it comes about going about getting a home loan, I suppose the key figure people are looking at is that interest rate.
That's correct.
Yeah, but that's not the be all and end all.
Potentially not, no.
So like you can reasonably easy these days find some of the advertised rates. They're either directly on the bank's website, or you go through some of those sort of search engine things, and they can produce something for you. But actually, which one is right for you, it depends on your circumstances, and that is really when you need some expert help.
Yeah, that's right.
Like I know this, like going through it recently, you've got, as you're already pointing out, there's variable rates, there's fixed rates, you can have a bit of both.
Yes.
As well. There's different terms.
Yep.
For how long you fix things for.
Yep.
There's all that, so broker can definitely help run through these things.
Yeah, and there's also those life events that come up that what generally happens is when we're sitting down and we're having that conversation, we'll actually talk about what's happening in the future. So if your plans are that you want to start a family, or you are nearing the end of your working career and you're looking at retirement, or you're looking at receiving an inheritance, then we need to tailor that loan and those products to specifically work within those events. So certainly one thing I wouldn't be offering or suggesting as being the number one thing to do is taking a fixed rate home loan over a 5-year period when you know that you might have an inheritance coming in the next 6 months. And the reason for that is with fixed rate home loans, you actually can't pay down those loans if you reduce a fixed rate home loan by the principal component, you can actually be penalised. So in that instance, you would be far better having a variable rate home loan, knowing that you've got an inheritance coming in to be able to offset those interest payments or the principal component. And if I can, Drew, I'm just going to share a screen with everyone.
Oh, please do.
It's a screen that will hopefully make a little bit of sense when I bring it up. So I'm just going to...
Yep, sharing now.
All right. Is that working?
Yep, that's working fine.
Beautiful. So there are two types of home loans when we're talking about the features and benefits of what banks offer. One is a package style home loan, and one is, and we talk about package style home loans as being, you know, your frills home loan. So you get everything with it. And then you've got your basic type of home loan, which doesn't come with the extras. It's just a basic interest rate with not many features and benefits. So if I can take this example that I've got on the screen here, where, and we'll say that there's two clients, they've got a young family, and I'll paint a bit of a picture. Let's just say husband and wife. They might have two kids, and they've got some everyday accounts sitting there. They might have a credit card that they do all their spending on, but they do have a home loan which their main goal is to pay down. So in this setup, we have got the home loan. We've got 5 everyday accounts. One might be your bills account. You might have a savings account, a pay account. You might have some kids accounts sitting there. And then you might also be, just for the purpose of Munros here, a business holder. And you might have some funds sitting aside, which you've got sitting there for contingencies in the business. So you might have your GST or your PAYG sitting there waiting to draw down on. Then you use your credit card for all your monthly expenses. So this is kind of a setup that I see day in, day out, and it might resonate with a lot of people as being a typical setup to hold your accounts and your banking. But if I can give you a bit of an insight into this setup. So this setup really only works if you've got an offset account potentially. So in this instance, this family have got the account with the most amount of money sitting in it, so that $12,500. They've got that account offset to the home loan. So the beauty of that is that the $12,500 that's sitting there is actually coming off that $500,000. So when the bank calculates that interest, they're actually only paying interest on $487,500. And that's because the funds are sitting in the offset account there. Now, they would actually probably be far more beneficial to have some more of those funds sitting in that offset account. But for the purpose of their everyday accounts, they might not have the time to be flicking money back and forth all the time. And they probably like to have their accounts set like that so that they know their budget. So that's one example.
I think at the very least they're going to save the annual package fee.
Yes.
Is what I'm quickly calculating there.
Yes. So the annual package fee with a package style home loan, anywhere from $300 to $400. They usually sit at $395. So if you've got NAB, Westpac, Bankwest, ANZ, and I've missed one, Commonwealth, then the annual package fees are sitting around about $395. There are some banks though that offer multiple offset accounts, and this is something that once I explain it to clients really looks good on paper. So well,
can I just say, yes, definitely a time to listen in on this, because I wasn't even aware of this multiple offset account option. You know? and I've gone through a broker too, so you know,
there you go.
Possibly even a secret amongst brokers.
Yes, it might be. And this is a point that's where, as a broker, it becomes really important to know our stuff, basically, if I can say it like that. We need to make sure we are cross policy changes all the time. If there's a new home loan that comes out with new features and facilities, we really need to understand who that's going to work for, which client is going to benefit from that package. So I put a little bit of an idea of to which banks offer this type of package, and this is the type of package that I really like. for me personally, for my everyday banking. So CBA, Bankwest, ME Bank and AMP Bank all offer multiple offset accounts. Now, what that means is you can have up to 10 with Bankwest. CBA, it's more. ME, I believe it's 10, and AMP, I think it's 8. I might need to check on that one, but the idea is that there's multiple. So what you can do is you can set up your accounts to all be linked to the home loan. And by doing this, effectively saving without having to think about transferring money on the go, the funds that are sitting in that home loan. Package styles home loans, as I said before, have an annual fee of $395. You need to have at a minimum about 10, depending on the interest rates. At the moment, interest rates are, 3.5%. So you really need to have about $10,000 sitting in your offset account at any one time to save the annual fee. If we're looking at moving to another bank and the interest rates are potentially lower, then you might need more in your offset account. So we will calculate all of those figures to make sure this is the right thing for you to do. But the beauty of this is instead of paying interest on, $487,000 as we did in the previous example, well, now we're paying interest on, and I'm going to refer to my little notes here. We're saving interest on around about paying interest on around about 560,000. I haven't got the figure there.
13,000 we're saving.
So the beauty of that is, without even thinking about it, all of a sudden we're saving interest on the term of the loan.
Trish, I've got a question for you. Let me spotlight my video. When it comes to this, say, as you said, you probably need about a minimum of 10 grand, give or take,
yes,
to get the savings out of that extra annual package that you pay.
Yeah.
What if I'm buying the home, I'm using up all my savings for the deposit, I'm not going to have that, but maybe over time I will build up.
Yes.
How do you weigh up that option?
How do you justify it?
Yeah, because do you perhaps look at going, I'm just going to start on a simple package, don't worry about the offsets, and then change it sometime later, but then there are costs for changing, refinancing. I know we're getting probably a bit ahead of ourselves.
No, that's a good question. With the package style home loans, if you are looking at buying a house, or you're getting into the market, or you're refinancing, then it may be worth going on a package straight up, because you can get an extra discount on that rate. So package style loans generally come with a cheaper interest rate. So it might not be worth it if you're on a package style home loan now, then your interest rate is already set. It's already you've already got that discount applied to your interest rate. So it's worth considering if that's the right product structure for you. But if you're looking at buying, establishing or refinancing or renovating your home, then a package style home loan may come with an attractive interest rate to entice you over to that rate. But I think the idea of sitting there and actually working out what your budget is and having it really easy to maintain and easy to see, the package style home loans do that for you. So you can, down the track, if you want to, say, look, actually, I don't need that package style home loan anymore. I've sold off an investment property. My banking structure isn't as complex as what it used to be. Then you can change your loan, do a home loan transfer to a different product.
Okay, that's good. Yeah.
And
another thing they build into these packages is the credit card there, which I suppose can be a bit enticing for people as well.
Yes, and I've got a disclaimer down there, just to the point number one. The credit card, if you do have a credit card, it must be paid off every month.
Yes.
If I see someone and someone comes to me and they've got a credit card and it's not being paid off every month, the first thing I do is, right, we're going to sit down and do a budget, and we're going to work out what are your net income coming in, and then what are your net outgoings. And I know that to some people that sounds really basic, and I do have people roll their eyes at me saying, Trish, we're not doing a budget. But the thing that I will ask you is, straight up, how much are your monthly expenses. And if you can't tell me roughly off the top of your head, how do you know if you're living within your means? And I guess that's a big one, because we all want to get ahead with paying our mortgage off and you know, going on that holiday and all those kinds of things. But until you know what your income is, your net income versus your net outgoings, you don't know how much you should be saving. And if we can sit down together and do that as an activity before we start looking at your everyday banking, it's actually a really good thing to do. And
you're going to have to do this anyway when you go and put in your loan application.
Yes.
Right. So
we do. We need an understanding of what your living expenses are. So it is really important to document them and to live within your means.
Yeah. And back on those credit card things, if you're not paying it off monthly, you know, look at the balance transfers, 0%, you know, those options.
Cut the card up and use it like a loan. Cut the card up and repay it off.
And when we were having a chat earlier, when we were having a chat earlier about this webinar and planning for it, when we were having a little bit of chat about credit cards, I said, "Oh, what about those schemes where you pay afterwards?" If I can pay.
And I think I might have rolled my eyes at that. Look, the banks aren't keen on afterpay. It's a credit facility at the end of the day. Yes, I know people say it's lay-by and, you know, it's buy now, pay later schemes, but they'll include that as part of your daily expenses. So if you've got a $80 afterpay going out every single week, they're actually going to use that afterpay, $80 every single week, and take that into your income when they're servicing your application. So it may affect your borrowing capacity. So
does that mean, are they double dipping? Are they including the initial purchase and then all the repayments, or
potentially,
or
the repayments, they're going to use what they see on their statements. So when we do a new home loan with a bank, they want to make sure that product is not unsuitable for you. Now, that's not my terminology. That's a government responsible lending terminology, but not. The banks need to make sure that product or lending you this money is not going to put you in financial hardship. So if you have an $80 afterpay coming out, and that's due to finish after you get the loan, they're going to include that in your statement of position as a liability. So
so they're also liability and then also the expense side as well.
Yeah, because they're going to see your statements and they're going to see that that's an ongoing expense. So you are being, effectively you're being double charged for that afterpay. So very important to look at afterpay. And if my big thing
I want to say, we're not bagging out afterpay necessarily here. Like, there's plenty of them.
You just need to know that if you are going to use afterpay, it could affect your borrowing capacity.
If you might have been using afterpay or whatever, or have some, shall I say, some lavish spending going on. Love the Uber Eats or whatever it happens to be. A bit too regular basis in terms of loan application.
Yes.
What sort of period of time are the banks looking at? Like, can you go, all right, today I'll stop these things which the banks aren't going to necessarily like when it comes to the home loan application, that, like sort of like your credit score.
Yeah.
So I suppose it's in that.
So they generally want to see 3 to 6 months of your spending history. So when we get the statements from you, part of the refinance or the new purchase, the banks will go through them with a fine-tooth comb and they'll pull out any big ticket items and they'll make sure that you've included that into your living expenses. So really important to make sure that if you have got big ticket items coming out of your credit cards, that you review that and make sure you do include that as part of your living expenses.
Yeah.
And
then some people might then think, okay, can I, live quite, within the means of the bank for 6 months, get the loan, and then go back to a lavish sort of lifestyle? What's the deal there?
So that's something that, yes, they can. They could go back and.
So once you've got the loan, you got the loan.
You've got the loan.
Yeah.
And if
but it doesn't do well for this next part. How can you pay your loan off faster?
That's right. Yeah. So as part of what I do with leading edge finance clients is I will sit down and organise an annual review every year. So in that annual review, I probably know a little bit too much about your spending habits, but I would look over the last year of what your spending habits have been. And we would work in and say, okay, you know, how's the last year been? Have you been on some holidays? You know, have you reached your goals? Were there any short-term goals that you were looking at doing? Where are we at with them? At the same time, we would also review your interest rate, because the banks have two different interest rates. Well, they have lots of different interest rates, but namely two different interest rates. One is your interest rate, what you're set now. So that's a discount off the standard variable rate. And then they have a new to bank interest rate. So if you're a brand new client and they're trying to acquire new business, there's a rate called an acquisition rate. And that's how we keep the banks honest as brokers, because we price those acquisition rates when we're doing our annual reviews. We make sure that the clients aren't being ripped off by their existing bank.
There's two rates there.
Yes.
There's two rates. A normal bank rate.
Yes.
And a new to bank rate.
That's correct.
Okay, you got to tell me about this.
Okay.
This has got to be another secret. Like, what's going on here?
Okay, here's another secret.
And which one's lower? Is there always one lower?
No, the new to bank rate is generally lower.
So sometimes it might be a little bit.
Sometimes.
And then how much do these change in terms of your fixed and your variable, or is they back
all the
standard?
time?
Oh, they're changing all the time.
All the time they're changing.
Okay.
So let's just say the bank, a bit of economics 101. The bank acquires an investment of $200 million, and they've secured that investment at an interest rate of 2%. They might go out to the market because they've got to on-lend that money, or they want to make money off it, so they're going to on-lend that money. They might go out to the market with a cracking rate of, say, 2.5%. And they're saying, right, for new customers to the bank, we're going to offer you 2.5%. But as a client of that bank already, you're sitting in the background going, well, hang on a second, I'm paying 3%. How come new customers to the bank who aren't loyal, who haven't shown that they're loyal, are getting 0.5% less than me? And it's got to do with that acquisition rate. New to bank lending is going to attract a better interest rate naturally. And if I can give you an example of that, who's ever had car insurance and taken car insurance and then just paid it every single month, and after a few years you've gone, pretty sure I'm getting ripped off here, and you call up the insurance company and they tell you, oh, actually, yes, we can give you a 15% discount. And you go, well, why didn't you do that for me right back when a year ago? They don't do it. So
they jack it up after like the first year or two.
Correct.
Yeah, I've had that happen and gone, oh, this is a great rate.
Correct.
Next year comes along, what's this?
Yes. Yeah, exactly.
And the banks do this, bank, so you get a rate, say sometime last year you might have got a rate at 3.3%, to say that.
Yep.
There was a couple of interest rates cuts.
Yep.
They didn't pass them on completely.
Correct.
Maybe your rate's down to 3% now.
Yes.
But then if you look at the new environment, if you're going to get a new loan, you might be looking at 2.8,
yes,
2.7 on a variable.
On a variable rate.
Or you could switch to like a fixed and maybe 2.2 or 2.3%. Yeah.
Yep.
And this is why it's incredibly important to have these reviews.
To have the conversations.
Yeah, especially this time. And this is why we've got this webinar going on.
Correct. And I think if I just go back to that insurance analogy, so you call up your existing insurer and they say to you, look, we'll give you 15% discount. Yes, you've been with us for 3 years. But you think to yourself, you know what? No, actually, I'm going to call up a couple of other insurance companies and just see what else I can get out there. And what you find is, instead of saving $200 a year with that one insurance company that you've been with for three years, you're actually saving $400 by moving to another insurer. So same thing with banks. It's about keeping them honest. But instead of you having to make that phone call as a broker, that is what we will do. So, really important.
I suppose another benefit of having the broker and you're there behind the scenes looking over the situation is, me as like the borrower, I'm not thinking about it all the time. It's just been paid.
Yes.
You come along a year later, hey, we can get a better rate here.
Get a better deal.
Yeah.
And the advantage of me doing that for you as my client is potentially you're at a barbecue on the weekend and you say, oh yeah, I got a phone call from my broker during the week and she was able to get me another, $3,000 a year savings. Your mate's going to go, I never get a phone call from my bank or my broker. And that's how.
Well, how often are you going to get it from the bank?
Well, exactly, never. So
that's what the banks don't tell you.
Exactly. So I wanted to give you, before we move on to the reviewing the loan features, which we've done a little bit about, but I just want to give you an idea of what are we talking. You know, I'm throwing you interest rates, fixed, variable, 3%, 2.3%. What does that mean as far as a dollar figure value goes?
And just to be mindful, Trish, we've probably only got about 5 more minutes before we go into the Q&A section.
Okay.
So
I got excited.
A lot of this stuff will have to be in the part 2.
Okay. All right. So
juicy stuff, but definitely very valuable.
I know. I get excited talking about finances. So the average Australian mortgage, thanks Google, I did Google this earlier. The average Australian mortgage is sitting around about $385,000. So $385,000, I would say that if you take into consideration the people who have a mortgage at the moment, you're looking, early 20s up to around your 50s, 60s. Some people might have investment properties, so a bit longer. But your average is around for $385,000. So if I crunch the numbers, $385,000, let's just say your interest rate at the moment is 3.3%. And by moving to another bank, I can get you as a variable rate 2.7%. So that's a 0.6% savings. If I work out in a monetary figure what that works out to be, it's $2,310 a year in interest that you save. So that then
per year.
That comes off your loan. So, or back in your pocket to do what you want with. Hopefully comes off your loan instead of a holiday to Bali, but it's your money. And if I can tell you now that the banks have got some cracking low fixed rates, and we're seeing the fixed rates around the 2.3%. If we use that same scenario, so if your interest rate was 3.30% and the interest rate I can get you now is 2.3%, you're looking at a savings of 1% a year in interest, which works out to be $3,850. So huge savings there. And that's on a loan amount, remember, $385,000. I can guarantee you that most of my clients who are in their 30s, 40s, and high 40s have a loan that's substantially bigger than that. They have properties that are valued
even more savings, but
more savings. So if your loan was, $720,000 times that by 2, you're looking at savings around $7,000 a year.
And you'd say, but you know how at present we've got such low interest rates. Like it's never been this low. Correct. Basically ever.
No, they haven't. No. You're right.
What's the normal situation in terms of variable and fixed? Is fixed normally higher than variable? It is, right? Yeah. So fixed is normally higher, but right now it's like a decent amount lower.
Yes. And that's due to COVID-19.
Yeah, so there's
this is why there's
opportunities right now.
Massive incentives at the moment to fix your home loan. And, some people say to me, but Trish, I just don't want to lock in all my money because I want to pay down some of my loan. And that's where we can look at setting up a loan, like a split home loan. Now, the advantage of splitting your home loan is you can have some on fixed and some on variable. You get the best of both worlds. So you can have the majority of your loan on a fixed rate at, say, 2.2%. And then you can have some of your loan on a variable rate of, say, 100,000. And if I just go back to that screen that we were talking about before, where I was showing you those offset accounts. Bear with me a moment, sorry. Right.
Yeah, brilliant.
Hopefully that's come through.
It's come through.
So if we were to have this home loan here of 500,000, let's just say that we wanted to set up a fixed rate to take advantage of that 2.3%. We can actually fix 400,000 of that home loan and leave 100,000 variable. Now, the advantage of that is these offset accounts down here are all still linked to the variable loan at $100,000. But for the majority of your loan, you're getting a better interest rate. And we call that a split loan application. You can still do it within your package, and it doesn't cost you any more to do it within a package. If you are moving to, say, a basic style home loan, and I've just changed screens there, sorry to do that to you, but no offset accounts on a basic style home loan, you would probably fix your whole loan there because there would be not too many benefits of having the accounts linked. And certainly you wouldn't be able to link them to a fixed rate home loan because the fixed rate home loans don't have those facilities.
Yeah.
Or if they do, they're not really worth having because you can only have a portion of that account fixed at 40%.
And all this like the fixed opportunities there and the offset accounts, okay, we haven't touched upon it today. But there's definitely tax advantages of having it set up certain ways as well.
And we might go into that next time.
Part two,
Yeah, we've got a lot still to cover.
Yeah, trust us. Yeah, you don't want to make mistakes, which Trish and I were having a discussion that we've unfortunately seen far too often where people have done a few things a bit wrong. And it's cost them a lot of tax deductions, a lot of tax refunds.
It really has. So bearing with the time frames that we've got, I think I might close out this session by saying the basic style home loan and the package style home loan really work well when you understand how your banking works. So if we go back to that previous scenario, if you've got a couple of kids and you've got your offset account sitting here, you can actually park some money in a savings account. We do this for our kids. So we've actually got 2 accounts set up, one for each of them, one for Thomas and one for Millie. And we sit a balance in those accounts that we're effectively holding in trust. Now, the reason we do that is because on our home loan, we're paying 2.8% interest. If they were to go out and I was to invest those funds for them, we wouldn't be getting any more than 1%. So we're able to put more money into their account because we're saving money on reducing the interest on our home loan. So if you have kids or you know someone who's got kids, double check with them if they've got offset facilities on their home loan. And if they're with one of the banks at the top, they can actually open more accounts, set up 2 kids accounts and offset their money into your home loan. And then you can actually put, compounding interest, you put the money back into their account. So there's another little hot tip for closing out.
Yeah, and shall we get into the Q&A?
Let's get into the Q&A, yes.
Okay, let me grab back control, Trish.
Go for it.
There we go. Okay, so I think, brilliant. Okay, submit questions using that Q&A button. I've seen a few come through. This has been part 1, just a mention of that. So coming through to your inbox will be a link to the recording. And should you need any help with smart tax plans at the moment, please let us know. So question, let's go through there's about 3 pre-submitted questions. And then I see there's a couple of questions from Edward and from Peter before we close out today. So question number 1 to you, Trish, is some general information about refinancing.
Okay. So when you're looking at refinancing, there's 3 main criteria that the bank will look at. The first one is they'll do a valuation on your property to make sure that there's enough equity for them to lend those funds to you. We kind of want to stay under the 80% mark. So what that means is if you've got a property worth $1 million, the maximum you can borrow on that is $800,000. We want to make sure we stay under that 80% mark because the banks, anything over that, bank will charge lender's mortgage insurance. And we might do another Q&A on lender's mortgage insurance at another time because that's a beast in itself. But yeah, first point, making sure there's enough equity in the property. The second point is, do you have enough income to service the loan repayments? Now, the beauty of the market at the moment is we are seeing interest rates at all-time low. So it's giving borrowers the capacity to borrow more, giving clients the capacity to borrow more. So based on your income, PAYG or self-employed, we can work through your financials. There's a few things we can add back if you are self-employed. We're not just going to take what you pay to the ATO. We can actually add back in their depreciation, interest expenses and whatnot. And if you have ever been rejected by a bank for income and you are a business owner, it's really important to speak to a broker because there's certain banks that will give you more back for certain expenses that we can add back. So yeah, it's really important on that point. And the third cover, so we've got the security, have you got enough equity? Can you afford the loan? And the third one is your character. Are you a good person to lend to? So do you have defaults that are unpaid on your credit file? Or do you have your accounts constantly overdrawn. The banks will check this. So they're the three main criteria of refinancing. In addition to the banks checking that information, the other things we need are statements on your account, your ID, and a chat to fill out some information. So I've been doing a few during COVID, doing a few refinances over Zoom, and we can pretty much identify you over Zoom at the moment. So no need to go into the branch, just a matter of speaking to myself, get the application underway, and then we'll do evaluation at the same time. So hopefully that answers that question.
Yeah, definitely some good stuff there. With the IDing over Zoom, is like getting your ID out, putting it in front of the camera here.
Hold your driver's license, and then I take a screenshot of that, and that goes with the application.
Yeah,
so
right there. Yeah, okay.
Good old technology.
Hold still. Okay, fantastic. Let's go to number 2. The current home loan rates and minimum deposits. I think we touched a little bit upon this, but
let's cover it off again. So I'm going to cover off if you were an owner occupier, so that's going to be you living in the property. The current interest rates for variable are sitting around about 2.7, 2.8%. If you were looking at a fixed rate, as I said before, you can get them around about 2.3, potentially lower. And if you, I'm not going to cover off interest only, that's, we'll do that in another scenario, but that's based on principal and interest repayment. So that's a reducing debt down. And minimum deposit is 5%. You will pay lender's mortgage insurance on top of that, but yes, a minimum deposit is 5% on the purchase price that you are looking to buy. So hopefully that covers that, answers that question.
Fantastic. And number 3 of pre-submitted questions are, will banks consider monthly super drawdowns as part of capacity to pay a mortgage? That's an interesting question.
It is an interesting question. And as we start seeing more people getting to retirement age with mortgages on their loans, this is a very big topic at the moment. The short answer is yes, they will. Banks will consider super drawdown as part of capacity to pay a mortgage. There are a few little ins and outs around that. The first one being it must be an exact amount, so you can't draw down $2,000 one month and $10,000 the other month. You must have that as an ongoing set for at least 12 months, an ongoing drawdown payment from your superannuation. You must also have a substantial balance in your, now that's the bank terminology, not mine, must be a substantial balance in your superannuation fund.
How much is that?
Terminology depends. If you're 80, they probably only want to see, 180, 200,000. But if you're 60, you're going to need more than that. So when we're looking at the substantial balance, if I can put that in inverted commas, it's really going to depend on your age, your ongoing living expenses, and the balance of your home loan.
Yeah.
Okay. So
do they consider much about where you're buying as well in those scenarios? Like, do they have an opinion of whether you're buying, say, here in Perth or up in Karratha?
Yes. So postcodes do make a big difference to the borrowing capacity, but it comes back to that deposit. So generally, if you are looking to buy a house and you're using superannuation, you would need to put a deposit in anyway. It may be restricted that you need to put a 20% deposit in as opposed to a 5% deposit.
Yep.
Okay. And just on that superannuation drawdown, the banks may not use 100% of that income. They may shave that to say 80 or 90% of that income.
I love that terminology. Shave that.
Shave. So hopefully that answers the question. But more than happy to take that one offline and in specific detail work out exactly which bank would look at.
Explore those options. I mean, that's what what your broker's for.
Correct.
Okay, so that's the pre-submitted questions. Now we've got the other ones here. So Trish, Edward says, is it better to get your loans through one of the big 4 banks or through one of the smaller online lenders?
Good question. It really comes down to your personal preference, and again, those features and facilities. When I hear people say the big 4 banks, I think of, obviously the big 4 banks, but you could almost include into that St. George, Bank West, Macquarie Bank, police and nurses, they've all got branches here in WA. ING don't have a branch in WA, but I'm finding a lot of people are refinancing with ING. They're an online lender.
They're very strict though, aren't they, in terms of like the quality of the borrower?
They can be.
That's the reputation they have, isn't
it? It's changed a little bit.
Okay.
It's changed a little bit as they acquire a bigger portfolio of clients. Previously, I think they used to take on clients who were, refinances, not new purchases. So they didn't have a lot of loans that were sitting in that 90 to 95% borrowing. If you can imagine that a bank's loan book is split into chapters. You kind of want to keep those chapters fairly equal to diversify your risk. If you've got a chapter that is, 40% of that book in one particular area, and let's just say that area is at 95% borrowing capacity, and the housing market crashes, then all of a sudden your book, your risk is huge for that area. So the banks tend to spread. In saying that, the big four banks would have a bigger, they would take on a riskier client as opposed to an online lender who wouldn't potentially take on that riskier client. So,
or if the online lender is taking them on, are they a bit more premium rates? Is that?
They could be, but
so not necessarily.
Not necessarily. And I think the reason online lenders are coming about more is because people are happy to research, but they don't have the staff in the branches. And I think that's, if you think that you're going to need to be one of those people who wants to pop into a store or make a phone call to sort something out really quickly, you're going to have to be patient with those online lenders, because it's a matter of sending an email, waiting a week, potentially getting an email back. But, I'm more than happy to recommend, as part of our process, an online lender like ING. And in fact, I do have quite a few clients with ING at the moment. So hopefully that answers that question.
Yeah, fantastic. Okay, so another one here also by Edward is, can you please explain comparison rates? Yes. As I hear conflicting information on whether to use them. I think that's a great question.
That is a really good question, Edward. Thank you for that one. So comparison rates are a rate that the banks need to stipulate when they are advertising a mortgage. The comparison rate is generally run over a 25-year loan term based on that specific product. Now, going back 10 years, I would say that whenever you were shopping around for a mortgage, the comparison rate was the be-all end-all. That would tell you if there were any hidden fees and charges within that mortgage. The issue I have with a comparison rate these days is, how often do you stay nowadays? Do you stay in that mortgage for the lifetime of that loan? That's, i.e. not making any changes, calling up, getting a new interest rate. It's very unlikely. It's not the sort of thing that you do these days. So the comparison rate might be that it's 3.5%, but your introductory rate for that loan is 2.2% because it's fixed for the first 2 years. And then after that, it rolls to a standard variable rate. And that's what bumps the comparison rate up. However, after those 2 years of it rolling out of their fix, there is absolutely nothing stopping you from taking that rate and repricing it with the bank and saying, well, I don't want to roll to 3.5%. How about you offer me 2.7% like you're offering your new customers? Then the conversation point is, well, no, we need to change the product, or okay, no worries, we'll go have a look at what other banks are offering us. And because the process to refinance has become so straightforward, people are doing it all the time. So to answer the question, is the comparison rate the be all end all? Is that what you look at? I don't think it is these days. I think the banks have to include it in there to make sure there's nothing that's going to, well, government policy, if you're advertising, you have to include a comparison rate, but we simply don't stay in those products for as long as what we used to. So hopefully that answers that question, Edward.
Yeah, fantastic. Okay, Peter asks, this is interesting. Peter says, my current variable interest rate is 2.39% on my prime residence property. It's a full offset loan with no monthly or yearly ongoing fees. Are you confident you could get a variable, fully offset, no fee loan rate better than that?
Did you say 2.34%?
2.39%.
2.39.
To me, that sounds absolutely unbelievable. I
don't think I can get a better rate with that. Stay with the bank.
If you've got that rate, that's incredible.
That's a really good rate, yeah. Because fixed rates are sitting around that 2.3%. So there's only 2 banks that will offer a 100%. Actually, I think it's only one now. 100% offset facility to a fixed rate home loan, and that is Connective Home Loans. It's a white label product, so they're issued through a bank, but yeah, white label product. And their interest rate on their fixed, off the top of my head, I'll need to check this, I think it's around 2.3%, 2.32, and that has a 100% offset facility. So if you're getting a variable rate 2.39%, yeah, no, you stay there.
You've done well, Peter.
You have,
well
Peter.
done. Yeah, good peace of mind there. And Anonymous says, hi, do you have any advice about restructuring your home loan to take advantage of the $25,000 government building renovation grant? I think by restructuring means refinancing.
Well, there's a couple of points to that. So the government that's the home builder. So you have to meet the criteria outlined by the federal government. So I'm assuming we're talking, that's the 25,000 is home builder. So that's the federal grant. Now, to qualify for that grant, you need to do substantial renovations to your property. And so you need to spend what's listed in their criteria. So I believe off the top of my head, that's $100,000. Might actually be $150,000. So by restructuring your home loan, I can give you cash out for $150,000. You can go and do those renovations with a builder. Has to be a licensed builder. And it can't include pool, shed, landscaping. It has to be to the main structure of the property. So yes, we can do that. We can draw down on those funds using the equity of your property and give you the cash to do that, and then you would qualify for the $25,000 grant.
Excellent. Okay, well, we've just gone slightly over the hour there, so that will bring a close to part 1. Just want to reiterate again, if you've currently got an accountant who's not Munros and isn't having these conversations with you, then make the switch to Munros. We'd be happy to help you out and give you this valuable information. And part two is next week, same time next week with Trish, and we're going to go through more of the essentials and the secrets there. Plenty more to get through, absolutely. So thanks everyone for hanging around today. Thanks for your questions. Yeah, just on your way out, if you've got any questions back for us, just let us know, or let us know in the chat. And otherwise, we'll see you next week. Thanks very much.
Thanks, guys.
I'll turn the recording off now. Thanks.
See you later.